The Federal Reserve's dual mandate is starting to come into play, and here is why that is going to make mortgage rates look much better very soon.
I keep it real, I keep it real, I keep it real, just keep it real.
Hey, what's up guys? It's Sam Hartman, keeping it real estate here in Fort Wayne, Indiana. And as always, I'm trying to come to you and bring context and clarity to the real estate world so that you can be confident consumers when it comes to making real estate decisions. And today I'm talking about something that is on every home buyer's mind, and it affects interest rates. And so there's a lot deeper things happening past the interest rate that buyers hear about from their lender or buyers maybe see on a website. There's a lot of behind the scenes inner workings that all affect those interest rates. And so that is what I'm going to talk a little bit about today, is the Federal Reserve and their dual mandate. If you find this video helpful, make sure you share it with a friend. And if you don't want to miss any of my future videos, make sure you like and subscribe to the channel, hit that notification bell so that you're always going to get the most up-to-date market information. Now let's get into it. So I mentioned a dual mandate from the Federal Reserve, and what the dual mandate for the Federal Reserve is that they are to keep inflation low, and they've been very clear that their goal is 2% year-over-year inflation, and they want to keep employment full. Now, full employment typically is around like a 4% unemployment rate, so that's kind of the barometer that they're using there. But you can see how maybe sometimes these things can kind of push and pull on each other. They're not always going to happen at the same time. It's always a little bit of a balancing act. And that's why the Federal Reserve uses the Fed funds rate, the interest rate that they charge banks to borrow money, to kind of be a lever on the push and pull of these two things, inflation and employment. So if inflation is going too high, they tend to raise the interest rates to make it more expensive for banks and companies to borrow money, so that they're borrowing less money, there's less money coming into the economy. But as a lagging factor to less spending in companies, you're gonna start to see wages drop, you're gonna start to see employment fall off as well as a lagging factor to that. So this dual mandate is a constant push and pull, and we're starting to see some cracks in the dual mandate that should benefit interest rates for home buyers in the very near future. Before diving into the data, let's do a quick quote from Chicago Fed Chair President, who says, "The long arc over the last year and a half is inflation is way down, unemployment is creeping up, and the job market is cooling. And we want it to stabilize at something like full employment. And there are concerns whether it's going to stop there." So that's telling me the Fed is concerned about the labor market. Inflation has really shown a great trajectory in the downward trend with all of the efforts the Fed has been making. But I really have been thinking that it's going to take the labor market to start to crack for them to start easing their pressure on these interest rates. Now we're really starting to see that cracking, and the question is, did they push too hard on employment? And is that crack going to turn into a break? Or are we going to be able to kind of ease that pressure on the labor market to avoid a recession? So let's look at this great graph I got from Resi Club, and it is a dual mandate tracker. So it's showing these two data lines, the unemployment rate and the inflation rate. And you can see the blue line is that inflation rate. And so when inflation tends to spike in the history of the market, unemployment tends to spike shortly after that. And that is because of that dual mandate. Inflation rises, interest rates then rise as a response to that, and unemployment then begins to rise as well. So as you can see where we're at today, we had that huge unemployment spike due to COVID-19 pandemic, which quickly came back down. So we're not going to factor that in too much. But we see that large blue inflationary spike, and then we're starting now to see that unemployment number start to rise following it as an effect of these, for higher, longer interest rates. So let's really look at 5 key takeaways to this dual mandate and the current state of the Fed situation and what they're going to be looking at as we head toward a September meeting where everyone is really expecting them to cut interest rates at that point. So number one, inflation, which was 2.9% year over year, continues to decelerate and a downward trend towards that 2% goal that the Fed has. Number two, the unemployment rate has risen from 3.5% last year this time to 4.3% this year. Number three, we are starting to see recessionary red flags start to trigger. And we want to have a soft landing. We want to avoid a recession. It's yet to be seen if we think that's going to be possible. But because of these red flags kind of coming up, we expect the Fed to start taking action. Number four, over the past several months, Fed chairs have really changed their tune as to how they talk about their goals and talk about the future expectations of rate cutting. And that alone is a positive sign to hear them softening on their stance and to then start to expect some rate cuts coming here in the near future. And finally, number five, the future market is pricing in a 75% chance that there's going to be a 0.25% rate cut in the September meeting, and there's also a 25% chance that there could be a 0.5% rate cut in that September meeting. So what does that mean for the housing market? What does that mean for home buyers and home sellers out there? Well, with all of these expectations in mind, we've already seen some reduction in the interest rate environment, in the mortgage interest rate environment for home buyers out there, and are starting to see some relief. So that's phenomenal news. Now, necessarily when the rate cuts happen in September, we're not going to necessarily get an immediate drop due to that because the market is already pricing in that expectation. But the big benefit that could happen in mortgage rates and interest rates for home buyers is as the market stabilizes, as the Fed goals and the Fed's actions become more expectant and stabilize more, that spread that is between the federal funds rate and the 30-year fixed mortgage rate is going to start to shrink. Historically speaking, the spread between a Fed funds rate that the government sets and a 30-year fixed interest rate is about 1.7%. Today, it's currently 2.58%. So if we can reduce that spread, we almost have a 1 full percentage point that interest rates could drop simply from the risk and the variability in the market and the expectations coming down. If we have less volatility, if we have more consistency, that spread is going to shrink and could tomorrow reduce interest rates by almost a full another percentage point, which would be absolutely huge. Now, we don't expect the spread to shrink that quickly, but as it shrinks over time, that is going to be a huge benefit in the mortgage rate environment for homeowners to refinance or for home buyers to take advantage of more affordability in the market. I've done videos on this before in the past. It's called the 110 rule. For every 1% reduction in your interest rate, you achieve 10% more affordability. So let's use simple numbers. $100,000 house or mortgage. If interest rates drop by 1%, you can now afford $110,000 for the same price. So that's just a good example for buyers out there, how the interest rate environment affects your affordability and your potential opportunity to become a homeowner. So that's it on this topic today, guys. I hope you found this information valuable. And again, if you did, make sure you share this video with a friend. Make sure you like and subscribe so you don't miss the next video. And I know this might have been a little bit deeper in the weeds, but I like to share some of the mechanisms that are happening behind the scenes that are affecting you as consumers out there in the world. If you have deeper questions, if you need more information, if you want to take next steps or discover next steps, make sure you reach out to me. I'm always here to keep it real with you.